default stream, it's from Riverside. Yeah, here we go. It's now live on YouTube. Okay, huge delay. Wow, and now on X, still nothing live on X. Yeah, it should be coming now. It's loading, but doesn't actually start streaming yet on X. Not sure why. Yeah, you are on. Yeah, I see you. Perfect. Great. Okay, here we go. Hi, everybody. Happy Tuesday. Same time every Tuesday and Thursday. I come to you no matter where on the planet I am right now. But yeah, different location. You might have seen this location before as I am broadcasting out of a venue that I've been at in the past. Yeah, on the road, lots of activity been happening over the last 3-4 days. Bloodbath weekend again, as usual. I think the October 10th fallout is still having its repercussions through the market. Hey, everybody, just quickly, I'm Stefan Roost. I bring this to you Tuesdays and Thursdays. I'm the founder and CEO of Truflation.com. And here we are bringing you macroeconomic insights, talk of the town, what's been going on. We got a lot of numbers coming out of the US, very confusing numbers, a very confusing schedule due to the shutdown, impossible to navigate, super confusing for everybody, right? Because there are numbers flying around all over the place, from polymarket predictions to Kalshi predictions to rescheduling PPIs that aren't really real, not using the full data, employment data that's not really accurate and using the right data, ADP data, sort of all this stuff sort of been swinging around and coming around and trying to find. Sorry, guys, I'm going to shut down one of my tabs here, see if that frees up some RAM. I'm not on my usual infrastructure. I've got a laptop, and it is not the most powerful laptop, which I am pretty sorry about that. Anyway, here we go. Yeah, so what's going on? Truflation, right? We have an FOMC meeting coming up. Again, you can see that if you look at Truflation.com. If you're a subscriber, you can always get the latest Truflation figure live every day, whether regard of shutdown or not. You will always find on Truflation.com the latest update, 2.38%. That's your Truflation number. And we calculate this different. We use a composition of all these different assets from food and beverage, housing, transportation, utilities, health. And you can see all the breakdown over here. You can then filter them out to just overall. We can have just the food and non-alcohol. It's been dropping significantly. Food and beverages have been coming down rapidly. What is it? It's the food at home that's really coming down, and the food away from home, right? So look at food at home dropping a significant amount. So that's groceries and stuff like that. And then here, if you're a subscriber, you get to see these down in details. You see further breakdown of how this looks and what this data actually consists of. Here, housing up though, the housing, other lodging, right? So this is hotels, Airbnbs, etc. They seem to be screeching up there with the housing total being pretty flat overall. You can then take out the housing. You can then compare owned dwellings and rented dwellings. So the owned dwellings are pretty coming down. So again, owned housing. But here, look at this, the other lodging up, a huge spike. So hotels are charging more. People that can afford it, that travel a lot, they're being raped and reaped from their money as the season for traveling and holiday season is coming up. So the prices are spiking there. We see transportation, not the accommodation as it relates to the travel, not actually the transportation part of the travel. And here we can see transport in total, holding pretty flat and steady. Vehicles not doing very much, holding steady as well. but gas prices coming down. Look at that huge drop in gas costs. So again, oil is a huge matter of driving costs and inflation, and so that's coming down. All the meanwhile, utilities going up, right? The demand for energy, the demand for electricity is screeching to the roof. And that is being reflected in inflation prices, right? So over the last year, we're seeing roughly a 46.9% increase in inflation. So yeah, pretty spiky. Yeah, look at that. Here we go. 10% in total. Utilities in gas itself, significant growth, and that's why they want to switch on more gas, right, and have that come back. Yeah, that's sort of really numbers coming to you daily, updated daily, and we never miss a beat, right? And that's why it's really weird, right? So if you look at the November inflation numbers and you look at Polymarket, they're giving you the annual inflation, and this is just the prediction, right? So all they're trying to do is predict where the government numbers are going to come out at and what that number is going to look like. And they still are heavily dependent on the government numbers, right? So here you can see this market, this is a market about inflation over the 12-month period, November 25, before seasonal adjustment, as reported by the BLS, the Bureau of Lying Statistics, right? So they're now out and not making it, right? This market will resolve. And so if they don't report, they can't resolve. And we saw that last month. The government, the BLS, were not being able to report, so they didn't report. And so that was not shown. But either way, this tells us, based on volume of $30,000, that people are putting bets on where inflation will come out at. And here you can see a lot of the people are predicting 3% market, right? And so what was the BLS number? The last BLS reading was, as you can see, if you go to truflation.com, you can see here the last BLS reporting was 3. So they're predicting it to stay flat. I would predict it coming down slightly, but if we look at what we saw there, this is for the November read. Yeah, so this will come out in December. So you can actually think, if we look at Truflation, it's coming down significantly here and coming down significantly over here. 45-day lead time. However, remember, that's sort of the average that we're working at. So if I go, when's the result coming out? So I can come here to inflation calendar, economic calendar, and I can look at the US market. I can select here between all the different countries. At the moment, I'm just looking at the US, as you can see. Whoops, I don't want to show that tab, but here you can see PCE coming out on GDP coming out on today, or came out already. I think they've just reported it, and I'll share some of that. But here you can see when is the FOMC meeting and CPI, Wednesday, December 10th. So December 10th minus 45 days. What does that take us to? That takes us roughly to the 5th. And if we go back to the Truflation number, so we go back to inflation indexes, our Truflation index, you can click on here and it opens up 45 days. Where are we at 45 days ago? Around the 5th of October. That would be, no, it would be November, right? 5th of November. Yeah, it was slowly coming down, right? So we are seeing a drop since 31st of October in those numbers. And so if there's a drop in those numbers, and we saw the oil prices come down, gas going up, but other lodging going up, but that's really people that can afford travel, right? So that's a small portion of the overall housing market that stayed steady. And then you can see the big factors, food and beverage coming down, right? So that's coming down. So food costs are coming down. And we all heard that Thanksgiving costs are going to be 25% cheaper this weekend. So if that's the case, Walmart has also shared that the cost of Thanksgiving is 25% cheaper than last year. That's a reflection of what we've been seeing in our price reads that get updated every single day again, 24/7. We don't shut down. And that's the beauty of Truflation. Housing market, you can see flat, other lodging. So those are only people that can afford traveling. And that's a small portion of the overall 23% of overall housing. So it's rented and other dwellings that really matter. And here you can see more or less, if I take out other lodgings, you look at owned dwellings, it's like really coming down. You can see here the owned dwellings have been coming down for a reason where the interest payments and the outstanding mortgage, there's been very little refinancing of mortgages, which means that the overall positions in the mortgages are coming down. The outstanding debt load is coming down. If that debt load is coming down, then that means the payments are getting less and less overall. And so that's what we're seeing here. And so that's interesting. And in the transportation, right? So overall transport total is staying pretty flat, mainly because the vehicle purchases are staying pretty flat. The only thing going up is really even is the gas prices, right? So we can see public transportation coming down significantly, but gas prices going up, gasoline, oil, and other motor oil for the cars. But they're overall, why am I seeing that down? It says here, should be minus. Overall, it's down year on year, but it's still coming up, crouching up a little bit. But yeah, utilities, this is gas, natural gas, and that has a little impact on the overall utilities that are going up. But utilities is only 5 to 6% of household spending. So it's not that big an impact, but still, that's going to really drive up a bit. Either way, coming back to what the predictions are, if we look here, 3%, 46, if you bet a 2.9%, what are you going to get? So if I bet I'm going to buy a 2.9% read, let's put in $10 on that. What are we going to get? We're going to get a 10x return. That's not too bad a position to have. Outstanding exposure to that is not going to be too big. For $10 to make and walk away with $100 could be interesting. Maybe there's tax on the income, the capital gains that you make on that. So you got to take that into account because the tax man likes collecting money that they don't really deserve or have no idea how to allocate or spend. And then here, if you go for 2.8% read, you're going to get a $300 return. So up to you if you want to take that risk reward ratio, but it looks pretty attractive. But remember, this is, again, all people are betting on here is the prediction of where people are believing the number is going to come out. Who are these users? We don't know. What's the volume? It's $30,000 worth of trading that's taking place across ultimately 5 different marketplaces on the number of inflation. So if I take 30,000 divided by 5, here you can see where all the money's going, right? It's pretty equal, 5,000 each. So yeah, it makes sense, right? So so 1, 2, 3, 4, 5 markets, 30,000 divided by 5 would be about 6,000 each. And roughly you can see, okay, 7,000 over here and this by market. So wow, a lot of people actually betting on a ramp up, significant ramp up. What does this pay you? This pays you $90. So yeah, so if you're a trader and you know how to balance this off against each other, short, long, opposite, blah blah blah, then you can work with this. Anyway, that's it. And we have the same here. I think ultimately we've seen a significant shift after all of the latest news in the markets around Fed decision making, right? So where's the Fed coming out at? 80%, see a decrease of 25%. I mean, if you get bet on a 50 basis point decrease, given the severity, you're looking at $1,000, right? And you look at what's going on in the market right now. There are a couple of things that are going on right now, and I want to sort of share a bit around what this is and what's really going on. And I think it was really kicked off by this, what people are calling private credit, right? What is private credit? So private credit is really a lending by non-banks, right? These are like private equity firms. These are, so they're not accounted for in the bank's balance sheet, and which are publicly traded, and they need to be doing these filings and reportings. This has now grown to 15% of worldwide assets. So this industry is now, private credit industry is 15% of worldwide assets. What does that mean? This is a multi-trillion-dollar industry that is highly unregulated, and is really led by sort of private equity firms, prop trading firms, market making firms, right, that are actually all doing loans, right? And yeah, and so what does a loan like this sort of typically look like? It can be, I've built out a fund. Inside that fund, there are a number of companies in there, and those companies are all waiting for better days. They're not operating profitably, and so they need credit, line of credit, but they may be publicly listed. They may be in a, privately held before they get publicly listed. However, they have big backing, they have big cash flows, and so they can borrow a lot against that. Do they go to banks to borrow against that? Banks don't want it on their balance sheet, so they then go to private equity firms. They go to others who get out loans and then provide credit to those entities in there inside a fund, right? And so they wrap this all into a fund, and that is then coming to an end. For example, the funds have lifetimes of 5, 7, 12, whatever cycle they have lifetimes comes to end. And so they create continuation funds. So what is a continuation fund? It is a really bad name, but what it does is it's shut down this fund, create a new fund. This new fund buys all the assets from the old fund at an arbitrary number because you don't know what's in that fund and how it's valued. And then that moves on into this new fund, right? So old assets that I own through fund one move on into fund two, and I got a new bunch of investors in fund two, but I'm managing the fund two. The same people managing fund two are the same as ones managing fund one, and they decide the valuation of fund one. And of course, they've got skin in the game, right? So they're going to value fund one at a specific number that the last auditor gave them and they fought for, because again, their incentive is to achieve greater returns. So they're going to be working with the auditors who are doing the attestation to give them a higher valuation so that they not only get higher management fees based on total value locked, or AUM as we call it, asset under management, and also the upside and the gains associated with those assets in there. So if they've grown from 100 to 120, they get now management fee on the 120, and which is maybe usually roughly around 2%, they call it, and they make money on the gains of that 20%. So they make a percentage of that gain, right? They don't get all the gain. The investors get the first part back. So capital providers get money back, but they get a portion of that gain, right? They get maybe 20% of that gain as well. And so they're highly skewed to try and transfer this into a new fund to keep it alive, so they don't need to show that the fund is full of rotten assets. But in the new fund, they can sell it for 120 instead of 100, which is the last value that was put together in a negotiation with auditors. And we saw how that ends up. These are auditors that are being paid for by the fund managers that get a big fat check. They are also influenced and negotiated up in terms of the valuation of the assets to try and justify, especially if they're not publicly traded assets, because then you have a mark to market immediately as per public markets, but you then have some private assets in there. Those are the ones that they're going to try and upraise. Anyway, long story. Hope that made sense. Maybe we should map this out on a whiteboard. So hopefully it's not too complicated, but just go into Perplexity, check out private credit or Grok, and then Grok will give you, or Annie, your companion, or whoever you use, will give you a quick breakdown in your next car ride or train ride. Put on some headsets and then ask Annie to give you some idea on what is private credit and what that really means. You'll get a lot of insight. And really what triggered a lot of what's going on is this company called First Brands Group. It's a privately owned, again, private, so it's not publicly listed, U.S. auto parts conglomerates, right? So they have a number of different assets in there, from screen wipers, right? Filters for the air conditioning, plugs, the brake pads, all of this stuff, right? So they have this pool of all these things that go into your cars. And so they filed for bankruptcy. Boom, right? After years of debt-fueled acquisition. So they went and borrowed lots of money with private equity, right? So they used private equities behind them to then go borrow money and to go and do acquisitions, right? Because they were synergies if they pool all of these together, and then they can have a distribution network. Then you can sell them wipers. I can upsell you filters, plugs, brakes, all of those assets. I can then wrap that into the sale. But First Brands had borrowed a significant amount of money, right? So it turns out that, after looking at, they filed the report, and I think they showed that they were healthy, 100% of the assets, and turns out they had over, sort of liabilities of $10 billion, right? And they have revenue. I can't remember the revenue number, but that's what really got the whole ball rolling and created awareness around this, right? And you can see what this looks like, right? And so here we have some articles that go into that. And so you can then see what this private credit is. And this is what's really hitting the market, right? Billions of dollars vanished by low profile bankruptcy rings alarms on Wall Street, right? The unraveling of First Brands, a mid-sized auto part maker, is exposing hidden losses at international banks and private credit lenders, right? So that's it. Again, so the New York Times, I don't pay for it. I'm not going to give them a cent because it's mainstream media. I just don't believe in mainstream media anymore. So here, let's look at Yahoo Finance. Let me share this one. Maybe they give us some deeper insights. You can see here, FCA, which is another governing body that snoozed, Financial Conduct Authority in the UK, right? Alert after US auto part giants collapse exposes cracks in private credit. So this is somebody in the UK, most probably a UK bank that lent money. Sort of were, again, your bankers that are holding your savings are allocating money to a private equity firm or a First Brands that's backed by private equity firms that's trying to funnel and act as middleman to help leverage and pull together financing for this First Brands, right? And one of those financing entities is a UK bank. Otherwise, the FCA wouldn't get involved, right? And so here, Auto Industry Roots, founded by Malaysian-born businessman Patrick James, First Brands grew rapidly through a string of debt-fueled acquisitions. So they borrowed a lot of money to then do acquisitions across US and Europe, eventually controlling more than 24 auto part brands. So they acquired all of these brands, consolidated them, and then they made their revenue look good, right? So they're buying little companies, aggregating them, consolidating the revenue numbers so that they look then a lot bigger. The company's opaque off-balance sheet financing. So I don't know what opaque off-balance sheet financing means. Spooked creditors revealing a debt mountain stretching far beyond what appeared in its accounts, right? So that's, I guess, what everybody's worried about. This is really an accounting, issue. This is, but it is a big issue because it's having an impact across multiple different industries, right? And so it's not only over there. You can see this here on Bloomberg, BlackRock private credits, so even it's hitting BlackRock as well. Okay, I mean, here, BlackRock private credit CLO fails test as bad loan mounts, right? So again, even it's hitting even BlackRock, right? So, and then there's this company called Blue Owl. I don't know if you've heard of that, but that's another issue that's popped up. But BlackRock's managed private credits, a BlackRock managed private credit CLO. I don't know what that is. It may be a special purpose vehicle, loan pool funded via bonds. Okay. So they create, it's basically like a vault, right? So you create a vault. You give them money into that vault that has a yield, which is based most probably on the cash flow. People can buy into that. They give their loan into a pool, which then is issued to underlying assets. So that's sort of really what's happening. So again, that is where people are beginning to worry. Are these bonds issued by BlackRock or managed? So it's a BlackRock managed private credit lending CLO, right? So it's a liability entity. So it's a limited liability entity. So people are giving via bonds into this entity, which is managed by BlackRock. So BlackRock never has any exposure. Other people are giving it money, and it's going into this entity, which is managed by BlackRock. And ultimately, there seems to be a lot of bad loans that were made by BlackRock's management of these loans, right? And so that's becoming pretty messy. BlackRock even waived some management fees for the vehicle, right, which is rare. So they actually started not. So here you can see what's going on. Yeah, so BlackRock even waived some management fees, right, because they realized, whoops, it's getting pretty big, and we can't handle it anymore. So we need to make sure that we don't look too bad. Separately, an affiliate platform, HPS, reportedly marked through 400 million loans tied to questionable receivables down to zero. Right, so $400 million in loans tied to questionable receivables have been marked down to zero. Right, so bang, $400 million, whoosh, gone. Which maybe in finance terms, not much. 400 million, it's chump change, but in personal terms, it's a lot of money. I mean, that hits a lot of people, and then you sort of wonder what's under there, right? And so here, what happened at Blue Owl? There's another entity. So this is a ripple effect, right? So you have BlackRock, you have First Brands, and now there's this entity called Blue Owl, right? Blue Owl tried to merge 1.7 billion private credit fund with a 17 billion listed vehicle to give trapped investors liquidity and simply the structure, but the swap terms implied roughly a 20% paper loss for the private fund investors. After media and investor pushback, Blue Owl scraped the merger and also moved to limit or freeze redemptions in at least one private credit product, which immediately triggered gating, shadow banking, and contagion fears, right? So this is what's really going on. This has created the panic, and this is what's really at a much higher level driving the financial markets. This is what's impacting crypto, right? They need to unlock funds in crypto to be able to pay out. I don't know what, but how these guys are managing all these assets. But yeah, when people want to redeem, then I call on money and I need to unlock capital, and I'm trying to not allow redemptions, and I'm trying to gate the redemptions. So I'm making it bigger hurdle rates. And in all of these contracts, the redemptions are structured in you have to notify me once or twice a year with a 6-month notice, and then I can unlock it at the end of that 6 months with another 3-month timeline to distribute that. So this isn't crypto style where it's just bang, I redeem instantly and get my money back and I can take it out, or it's immediately liquidated if it falls below a specific threshold. These are all contractually negotiated with lawyers, $3,000 an hour lawyers, and $3,000 an hour accountants, and $3,000 an hour consultants, and that are trying to put these structures together, and $3,000 an hour financial analysts and investment managers. Anyway, that's really what's going on, and that's been one big portion. Now, you combine this and what's going on in Japan, right? So there's a big issue taking place in Japan. Oh my God, you're going to think this is a really depressing call, isn't it? Anyway, I'm just trying to give you a lowdown of what's going on, right? So we have the Japan carry trade. What's the Japan carry trade? People go to Japan and they borrow money at cheap rates. So Japan had very low interest rates, so I can borrow money in Japan and then move it to the US and invest in US, for example, treasury bills that's only 4%. So I have 0%, 4%, and that all works, right? Then all of a sudden, what happens if the yen moves? So if the yen moves, or if interest rates in Japan move, that has an impact, right? So then all of a sudden my cost in Japan is going up because interest rates are going up. So the differential is no longer 0 to 4%. In the US, I'm earning 4%. I'm borrowing at 0% in Japan. But now it's maybe I have to borrow at 3%, and I'm only earning 4%. So the differential is only 1%, the delta of 1%. Is that enough money? Is that enough risk reward ratio given the Japanese yen exposure I have, all of the fees I have to move money there and back and forth, and then to have exposure to buy in, buy out? Does that 1% delta cover my costs? And that's really what's happening as well. And these are large, again, hundreds of billions of dollars at stake, given the fact that there's a lot of borrowing in Japan. Japan is the largest debtor nation in the world. And what does that mean? where with all of that money, where is that being put to work? How's that being put to work? And that's being put to work in the US. And then you have the Dixie, right? So you can go, what is the Dixie? The Dixie is a basket of foreign currencies that here, where do we have the Dixie? Here we go. Again, another product we have on Truflation. You can go and find out Dixie. But the Dixie has Japanese yen inside the Dixie. It's a basket of goods where the Japanese is 13.6% of the weighting in the Dixie. And there are other currencies in there, right? So there's like the Swiss franc is in there. The euro is 57% in there. So you can see here, we, excuse me, we are updating the composition in this. So you will be able to see this. But right here, you can see the composition. It is currencies in the Dixie are euro, 57.6. The yen is in there as well. British pound, Canadian dollar, Swedish krona, and Swiss francs. Why not the Singapore dollar? Why not Hong Kong? Hong Kong dollar is pegged to the US dollar, so nobody really cares. But the Singapore dollar could be interesting as a stable Asian currency. Maybe that would be worthwhile adding in there. Maybe we should create a different type of Dixie, adding the Singapore dollars and rebalancing this, because I don't know how many people really, why is the euro in there? And why is that such an important asset class, given the euro's dominance? And renminbi is pegged to the dollar, so that doesn't really matter either. But yeah, these currencies are in there. So anyway, so that's happening as well, right? And so the price of yen against the dollar and that carry trade that's still out there and hasn't really unraveled itself. We've got our AMA coming up, so I'm not going to talk too much about inflation. If you want to find out more about our prediction of inflation and the numbers coming up for later this month, you can find out more over here. But I do want to share with you something really interesting. Obviously, Black Friday coming around the corner. We have a special offer for all of you out there, 50% off for the Black Friday. So if you add the code Black Friday, and when you sign up, you get a 50% offer. So you get all of this economic data at your fingertips for nearly less than $50. So that's 5 coffees in the course of a month. So 10 Starbucks coffees a month. So that's one a week, or I don't know how many you have, but if you think about that, that's really what that provides. And this gives you alpha opportunity to do trades. We talked about how you can then trade against eggs, the price of eggs on prediction markets, and make some profit there. But here we've got the spaces coming up. So we got EJ Anthony there. We got Michael Green coming on, and all this happening in real time while the economy is down and the data blackout has happened at the BLS. And we've had no reporting in October, no reporting. Truflation up every day. I talked to you about that already, so you can see it. And we're ready. Have you set your reminder? Follow Truflation on Twitter or X. Follow Truflation and you always get an update, and then you can easily set a reminder and you can find out more of what's going on there. And we'll talk a bit about this. How confusing is this? I mean, employment situation, reference period, 2025 will previously scheduled to be released on this day. Now it's going to be released on this day. Oh my God, it's like, oh Jesus, where is all this coming out? How's this so confusing? So we've got all sorts of data numbers being congested in this. This is why everybody's just going crazy. So you have, the private credit issue. You have, poly markets where people are predicting. You have this issue with the Japan carry trade. All of these things are creating huge panic. And then you have this huge data dump, right? Oh, look at all these data sets, JOLTS, and you've got here job openings, you've got produced PPI, you've got real earnings, you've got an employment situation, all of this, and this date and that date and that date. What's it reporting for back in September? We're talking about September. We're releasing these numbers in November, end of November. Oh my God. And it's all coming down in 1 week. Bang, 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 bang. And all before the December 10th. big date. Mark that date in your calendar and mark a date because we'll be doing a big FOMC and a big inflation update before that date. So follow X, Truflation on X. Follow us now, subscribe to our newsletter, and take advantage of this Black Friday. And we will be highlighting more and sign up, right? You'll learn about what the PPI number, why, and how does that impact everything, right? We have PPI in September coming out on the 20th, 6th of November. I mean, hello, good morning, knock, knock, knock. This is your tax dollar at work coming to you fucking 2 months late. Excuse me, guys. I mean, this is why we've built Truflation, and you need to sign up to support this so this continues to come to you 24/7 all of the time. And the only way we can continue to hold the governments accountable is your support and your battle testing, your proving that we have better numbers or wrong numbers or right numbers, but put us to work and pay for us to work for you so that the teams can get better data, more accurate data, provide better transparency, give you better attestation. And we will then make sure that you get the best numbers, like we did with the employment data, like we did with the PCE data. And we're going to be doing this with the PPI. You better be sure that we're going to be doing this. But also, Zero Hedge pointing out what this means. Again, X, food and energy. Hello, food and energy are the biggest components in everything that we do. We cannot live without food. We cannot live without energy. So I don't know why you take that out. Again, it's just some arbitrary manipulation of numbers, right? And then EJ Anthony, who will be on the spaces. So follow EJ Anthony as well, an advisor to Truflation. He is coming and onto the spaces as well. And we'll be sharing some insights on the 13,500 non-farm payroll jobs that are out there that haven't been created. Again, and you cannot believe these numbers, right? They're just, it is ADP payroll. So maybe a bit more accurate than the Bureau of Lying Statistics, but this is really, something to watch out for. Again, employment numbers, right? This is, again, fueling the fact that interest rates are likely to drop, and that's why we see what we see. Anyway, hope you enjoyed this. You've got 15 minutes. I'm going to drop off now, and you'll hear from EJ. You'll hear from Michael Green, who is a big macro trader as well. Lots of insights. He's been a friend of Truflation for a while, and always has very strong opinions and a lot of good insights. So stay tuned, join and listen. Coming to you in about 15 minutes from now. Thank you, everybody. Hope you enjoyed this. I'll be back again on Thursday. So listen in, sign up, and see you soon. Again, if you want to take advantage of Truflation, now's your time. Use the code Black Friday in caps, all one word, and you get a 50% discount. Thank you, everybody. Have a, I'll see you in 15 minutes. Thanks, everybody. Bye for now.